Hello there. This is Lloyd Lim of Honolulu, Hawaii, and I'd like to do just a few words on insurance. What is the basic concept? Now, most people would think of insurance as reimbursement for loss, unexpected loss, and that's right. Or they might say that insurance is a form of risk transfer, that the insured is transferring their risk to the insurance company. The problem with the risk transfer concept is it's not quite complete, and the reason is that there are other forms of risk transfer, such as a contract indemnity clause to pay attorney's fees, or a guarantee to pay the debt of another if they can't, which would not fall under a requirement under insurance regulation to file as an insurance company and put down a deposit and have a reserve and subject itself to regulation. In other words, there are forms of risk transfer which are not, they don't turn you into an insurance company just because you're providing those guarantees or indemnities, which happen all the time in contracts. So what's the secret sauce that adds on to this risk transfer idea? And that is this idea of risk pooling, that you are going to take premiums from the many people and put it in a pool. And you'll do that every year. And in that year, you'll therefore have a certain amount of revenues, and then you'll have claims on those insurance policies, which will generate losses. And hopefully your premium revenue will cover your claims expense for that year, which means paying out the losses and the cost of adjusting the losses and running the insurance company, plus a little profit for yourself. Doesn't always happen, but they make an effort to try to make it happen. And it's that risk pooling concept, the idea that, and you may have, and the idea is, of course, that the coverage provided by the insurance company, the total aggregated coverage is far in excess of the loss that they're going to pay out that year. The idea is that only a relatively small number of insureds have losses. And one of the things that has been found, and what makes insurance possible, is that there's an inverse relationship between frequency of loss and severity of loss. In other words, if a loss that is smaller tends to happen more frequently, and losses that are bigger happen to have less frequently, and so that makes it possible to do insurance, but it also explains why there's a deductible to shield the insurance company from small losses and to give insureds a stake in the game, right? Put some skin in the game. So they don't, they take necessary precautions themselves. They do want you to have an insurable interest. We don't want people gambling on the lives of another person, let's say, or some other guy's property, and then create the wrong set of incentives for bad behavior. You have to have an insurable interest in the property, the thing that's insured. But it's that idea, that basic idea of almost a collective, we're all in this together idea. That is what the insurance company does, and essentially acts as a kind of middleman for aggregating these dollars, a financial middleman. Without that middleman, frankly, it's not easy to do very much. Now, we have a regulatory system which would be at the federal level under the Commerce Clause, but the McCarran-Ferguson Act many decades ago delegated the responsibility of insurance regulation to the states, and there is a very advanced regulatory system that does that work. But the key thing to know is that the regulatory system handles licensed insurers in that area, and there is a non-admitted market of folks that will write outside of the regulatory structure. And that's really necessary because sometimes some risks are too big, they're too dangerous at any given moment to handle in the admitted market, and they end up falling into the non-admitted market, or what we call the surplus lines market. It sort of ensures that there is a regulated part and a kind of a fully market-based part. But I don't want to get too deep into regulation, but basically the main purpose of solvency can also involve rate regulation and other taking a look at the claims process and making sure the process is fair, and handling general complaints and other questions about the industry. But the regulation is not comprehensive. It's pretty it's primarily focused on the idea of solvency, and the main reason for that is if one of the biggest problems that can occur is if the insurance company goes belly up and leaves people hanging. That's a problem. So the insurance regulation has an ability to act almost like a bankruptcy court, and insolvency and rehabilitation powers try to keep that company from going under, or at least if it goes under, then do it in a right orderly fashion. But if you understand that this is not just risk transfer, it's also risk pooling, then that's you've gone a long way toward understanding insurance as a basic matter, Insurance 101. I hope that helps. Good luck.